Hey guys, welcome back to a brand new video. I'm RexFinance, and today we must discuss the moves I'm making in my personal stock market portfolio. This year has been one to remember, a record-setting first half of the year. Through the first 6 months of the year, my personal stock market portfolio was up 90%, over 90% actually, and I'm sure a lot of your portfolios performed in the same manner, just based on the content I provide on this channel. We look for smaller companies that have unfair valuations, that have really strong fundamentals, and we're finally being rewarded. 2022 was a very rough year because we were buying the dip, at least I was. I was buying the dip like crazy on all these companies that I believe in for the long term, but it felt like things would never turn back in our favor and stocks would never go back up. And we know that that's not the case. It's never the case. The stock market will always go up in the end. That's what it's done ever since the stock market was first formed. But I've been getting some questions, and they are fair questions. Am I going to sell my stocks now, take my profits, and buy back in lower? I've also been getting questions about the stocks I own and if I think it's too late to buy into these stocks based on my personal valuation. I'm going to address all of that in today's video. But my stock market return for this year in 2023 is really spearheaded by CleanSpark. We've been talking about CleanSpark on this channel for many years now. This year, CleanSpark is up 219%, but the other companies I own are also having really good years, like Li-Cycle, up 23%, and it's actually up 32% from its lows. Workhorse is a stock that I added back into my portfolio this year in 2023, and over the past month, it is up 32%. Flux Power is one that I've recently been buying, and I made a video on this just a few days ago, so if you want to check out that video on my personal valuation for Flux Power, I'll make it easy, click the ad in the top right-hand corner. This stock is up 26% over the last month. And if you've watched enough of my videos, you'd also know that I'm a big fan of PayPal. I think PayPal is tremendously undervalued. And since May 25th, PayPal is up 23%. And I'm sure for many of you, it's very convincing or tempting to sell out of your stocks and take this little bit of profit we've seen so far in 2023 because a dip just has to come, right? But I'm going to explain my personal thought process around all of this and explain to you what I'm doing. If you guys are new to this channel, I would appreciate hitting that subscribe button down below. Let me know in the comments section how well you're doing year to date in the stock market. I bet all of you are doing really well. If you're not, chances are you're a bear and you've missed out on this entire rally. I don't know whether to apologize on your behalf or not. Touchy subject. But let's start with this. I've been making a lot of videos lately titled, "This $4 stock is set to explode, 702% undervalued," or 574% undervalued, or 2,300% undervalued, or 1,986% undervalued. And that's factual stuff. That is not me clickbaiting you. And in these videos, I take you through my price target and valuation spreadsheets and explain to you why I believe these companies are so undervalued. This has not changed. These companies are still very undervalued, and these are the companies and stocks that I own in my personal portfolio. I don't day trade stocks. I don't swing trade stocks. I own companies, real companies, for 3 to 5 to even up to 10 years or longer if the company continues to perform. So let's consider this. If I believe that these companies are still hundreds of percent undervalued, is it worth it for me to take profits on 20% or even 200% on CleanSpark if I still think CleanSpark is over 500% undervalued over the long term? And that's what it really boils down to. Am I willing to risk losing my entire position in a company that I believe is tremendously undervalued just for a measly 20% because I think there's a chance that the stock could come back down and correct and I could buy back in for lower? In most cases, that's not true. That is not worth it to me. I don't invest to get breadcrumbs. I invest to get the whole loaf of bread. The whole loaf of bread takes time. It takes time in the oven, so to speak. But it's true. This market rally we've seen has not been very broad. In fact, it's been spearheaded and headlined by 8 companies. 8 companies are the reason that the stock market is up so much year to date. 8 companies. And these are the mega cap 8, as we like to call them: Alphabet or Google, Amazon, Apple, Meta or Facebook, Microsoft, Netflix, Nvidia, and Tesla. Since the beginning of the year, an equal weighted mega cap 8 portfolio has returned you 85.65%. If you put an equal amount of money in each of these stocks, you would have almost doubled your money already this year in 2023. And the return on these stocks since the beginning of 2018 is 380%. You would have almost quadrupled your money in 5 years by investing in these stocks. And this is the concern people have. These 8 companies have been running very, very hot. Bulls and bears alike can agree on that. They probably won't continue to run this hot. And as a result, because they make up such a large percentage of the overall stock market, people think that stocks are going to fall as these 8 companies cool off. Just by comparison, the S&P 500 is only up 18% overall this year, and the Russell 2000 or small caps is only up 11.5%. And since 2018, the S&P 500 is up 65.5%, which is actually pretty dang good return, but compared to 380%, it's really lackluster. And the Russell 2000 over the last 5 years is only up 27.5%. Keep in mind, when you invest in the stock market, usually on average, you can expect to double your money every 10 years. So the Mega Cap 8 is far outpacing that, but the Russell 2000, the small caps, have been far underpacing that mark. And year to date, the Mega Cap 8 is outperforming the overall S&P 500 by 67.5%, and the Mega Cap 8 is outperforming the small cap Russell 2000 index by 74%. And you can see here the outperformance since the beginning of 2018. This Excel spreadsheet is not very in-depth, but if you want to download it, it should update automatically as time goes on. If you want access to it, all of my members in the Discord server have access to this, a free download. You can hit the join button located right next to the subscribe button to get access to this spreadsheet as well as all of my other valuation spreadsheets, or you can hit the link in my pinned comment to Patreon to join the membership. Another thing that we can look at to see that small caps are really underperforming is the fact that their forward PE ratio is on average only a 14. Historically, the forward PE ratio on small caps is anywhere between 16 and 20. The green line represents the S&P 600 small cap index with a forward PE ratio of 14, and the blue line represents the S&P 400 mid cap index with a forward PE ratio of 14.3. So they are very, very similar. But if we look back in history, typically, small caps and mid cap companies have higher valuation multiples than large cap companies do. And that's because smaller companies usually have more growth ahead of them, and investors are willing to pay more for that growth. But you can see ever since the 2020 crash, this gap between the small cap and mid cap valuations and large cap valuations has been widening. And this is basically wider than this gap has ever been. This will eventually reverse. And just for fun, we can also look at the Mega Cap 8 forward PE ratio on this chart. Right now, the forward PE ratio for the Mega Cap 8 is sitting at 31.2. That is pretty high, although it's off of highs of around 38 at the beginning of 2020. But you can see how the Mega Cap 8 forward PE ratio has totally taken off compared to all of the other stocks, including large caps as a whole. And if we dig a little bit deeper, we can actually go back in history and look at the average forward PE ratios. I kind of already talked about this, but just imagine drawing a line across this chart at 14, where we sit today. That is severely under the historical average for small caps. For mid caps, it's very similar. At a forward PE of 14.3, that is still pretty far under the average forward PE ratio for mid cap companies. Now, large caps, on the other hand, I would say are actually a little bit overvalued compared to historical standards, but this has a lot to do with those 8 companies we've been talking about. And the other thing that's important to note here is, yes, the Mega Cap 8 have been outperforming the rest of the stock market like crazy, but the opposite can also play out moving forward, where the Mega Cap 8 stay sideways, or maybe they even downtrend a little bit while the rest of the stock market picks up steam and the stock market rally broadens. I, for one, believe that's what's going to happen. We can already kind of see this start to play out, where small cap valuations, although they're still very historically low, are up about 30% from lows set at the end of 2022. I've been on record saying that I think the May 4th bottom for the Russell 2000 will end up being the long-term bottom, and so far that has proven accurate. I don't have a crystal ball. I could end up being wrong about this, but ever since May 4th, small caps are up 14%. And the bottom line is, with small caps only up 17.67% over the past 5 years, they have a lot of catching up to do. Valuations are low and performance has been lackluster. That will not continue. Eventually, that will change and normalize. And that's why I've positioned my personal portfolio into small caps in particular. Now, yes, I own some Apple, I own some Tesla, I own a lot of PayPal, but for the most part, my portfolio allocation, a lot of it goes to small cap companies like CleanSpark and Li-Cycle and Flux Power. And maybe you're wondering why I've thought the May 4th bottom was going to be the long-term bottom for small caps. It all has to do with the federal funds rate. It's really not that difficult to understand. Around the beginning of May was when we first started to hear the word pause enter the news headlines on CNBC, on YouTube, when it first started to be asked of Jerome Powell whether a pause was going to come. You also started to hear rate cuts enter the news cycle. Those words got very popular, and it makes a lot of sense when you really think about it. The federal funds rate affects small cap and micro cap companies the most, and it's not even close, because these are typically companies that are strapped for cash, and if you completely take away the debt lever, meaning these companies can't take out debt because interest rates are so high, their only option is to dilute shareholders to raise money, which is probably part of the reason small caps have underperformed like crazy as the federal funds rate has gone up. And as rate hikes entered the news cycle, small cap companies and their stocks began to fall. But as we near the end of this rate hiking cycle, small cap companies are going to feel a lot of relief. Investors don't have to worry about the federal funds rate going even higher and stressing these companies out even more. As the federal funds rate goes up, more and more companies go bankrupt because, again, you're taking away one major finance lever that these companies can pull. And right now, the market is only pricing in one more rate hike before they think the Fed is going to be done for good with raising rates, and that's going to come at the end of July. Right now, there's a 99.8% chance that we see a 25 basis point rate hike at the end of July. I personally don't think this is needed. I don't think this is going to send us into a recession. I just don't think it's needed. In the September meeting, there's an 85% chance that rates stay the same. In November, there's a 71% chance that rates stay the same. And in December, there's a 65% chance that rates stay the same. And I'm guessing as we get more and more inflation data coming in, and we know the CPI and core CPI is going to continue to fall because we know shelter is going to continue to fall, which is a major component of both baskets, the probabilities that this rate hike we're set to see at the end of July being the last rate hike of this cycle probably go up. So as we exit 2023, and I realize I'm saying this in the middle of July, but in the second half of 2023, I would not be surprised if the NASDAQ cools off a little bit. In fact, I hope it cools off a little bit. We don't want to see another 40 to 50% gain in the NASDAQ in the second half of 2023 because that's just setting us up for doom. But there's enough companies out there with very attractive valuations, namely Disney, namely PayPal, and all these other small cap and mid cap companies that have a lot of room to go up in stock price, that overall the stock market should still be very lucrative to individual investors throughout the rest of 2023. So when you ask me if I'm going to sell out of my stocks and hope to buy back in lower, it's not worth it to me. I think these companies are tremendously undervalued. I'm not going to risk losing my entire position for the long term because I thought that stock prices could maybe fall and I could buy back in lower. I'm chasing the loaf of bread, not the crumbs. And for those of you that ask me if it's too late to buy into these stocks that I own, that's completely up to you and what you value these companies at. According to my valuation spreadsheets, I believe these companies are hundreds of % undervalued. So in my opinion, I'm going to continue to buy these stocks because I think they're still undervalued despite them going up 20 to 30%. But realize I'm also a long-term investor. That might not be your strategy. That might not be the right strategy for you. We both have different risk tolerances. We both have different financial situations, so I can't advise you on that. But in my opinion, I believe these companies are tremendously undervalued. If you want to download my valuation spreadsheets to come up with your own valuation, again, join the membership down below. It's like the cheapest one on YouTube. I'd love to have you join. Don't forget to comment down below how well you're doing in the stock market this year. And with that, have a great weekend. I'll be back with brand new content next Monday. Stay blessed, keep 10 toes to the ground and your chin up. Peace out.